Welcome to NEPI Invests. Today, I'm going to look at a company called Mitchell Services, which is a mining services company. I'm going to delve into whether they're a buy or possibly a value trap. So a value trap just means there's some underlying issue there, which means they are cheap for a reason. And if they're cheap for a reason, you probably don't want to buy it because bad things might happen for the future. So are they a buy or a value trap? So that's the questions I'm going to delve into today. Look at the company, and I might have a surprise for you or two. Probably not, but anyway. So what does Mitchell Services do? So I've already mentioned they are a mining services company and they're focused on drilling. So they have 100 rigs being utilized at the moment. Maybe not all at once, because that would be pretty much perfection for them. But they have 101 rigs that they can use. It's been growing steadily the last few years. So one of the things they look at is rig utilization, so how many rigs are they using at once. And you can see here the average annual operating rig versus revenue. So they've been increasing both during the last 5 years. So I've been following this company since financial year 2016. Been growing both fairly strongly. And at the moment, you can see $175 million in revenue. So good growth, both ends. So at this stage, would you say this is a value trap? Maybe not just based off these two things, that there are growing. The other thing they keenly look at is diversification of revenue. So they're making sure it comes from different commodities, different areas, and even different drilling types. For instance, in commodities, they're starting to increase their exposure to gold. That seems to be a big thing. Gold is more of a in thing right now. Zero exposure to thermal coal. Still highly, I won't say highly dependent on coking coal, but there still seem to be over or near half of exposure to coking coal, but increasing dependency on gold, which is maybe a good thing depending on how you look at it. Geography, still largely focused in Queensland, but they're starting to increase their focus throughout the Victoria, it seems like, and I'm pretty sure that increase in exposure in Victoria largely has to do with the gold fields there. And drilling type, so they are almost 50-50 surface and underground. Finances, so I've just looked back at the last 3 years to see if this is a value trap, looking at some see if there's any disturbing trends here, and there's really no disturbing trends. So in fact, there's one trend is share price and value. It seems to be not doing much, sort of stationary, while some other metrics are starting to increase. For instance, revenue is increasing, operating cash flow is increasing, free cash flow is increasing, enterprise values not increasing. But there's some very, very attractive numbers here. There's one thing you might see if you look at NPAT, net profit after tax. It's gone from $17.4 million to $7.2 million. So why is that? Especially when you compare it to operating cash flow and EBITDA. And this is one of the reasons why I don't ignore net profit after tax, but I tend to focus more on operating cash flow. That's my number one thing I do look at, and free cash flow. That gives a much better indication of the business, how it's going, than NPAT. And there is a reason, it's not a bad reason, behind that decrease in NPAT from last year to this year. Down the bottom there, I've got enterprise value divided by operating cash flow. It's one of my favorite metrics, and it's only 4 now. So typically for a value play, I like to see numbers less than 6 there, less than 10 sometimes, but less than 6 is ideal. And at the moment they're 4, so it is very attractively priced at the moment, and price to sales is very low too. So they almost got twice as many sales as their market cap, which is cheap. Another thing they do, which I really, really like, so capital expenditure, which is just payment of property, equipment, and other stuff. I forget what the other one is. Anyway, most companies just leave it like that. They don't break it down to payments or capital expenditure towards growth or maintenance. Those are two ones. You can have growth and maintenance. Because a lot of companies don't report what percentage goes in towards each, there is an assumption you say 50-50, which is a very, the old saying is when you make assumptions, you make an ass out of you and me. So it's a very general assumption that. But they've broken it down here, which I like to see. And they've broken it down, and when you see here, the majority of their capital expenditure, not a big majority, but a majority is going towards growth. And I like to see that. That's good. Now, why do we see a discrepancy between profits, operating cash flow, and EBITDA? Has all to do with acquisition they made, Deep Core. So they call it Deep Core acquisition accounting, and that's leading to an increase in depreciation and amortization of intangibles. That's increased quite a bit, both of those by more than double from 2019 to 2020. We've also seen an income tax benefit last year turn into an income tax expense, which that's a difference there of 7.7 million. So when you add those two together, that is why we've seen net profit after tax decrease from 17.4 million to 7 million. It's nothing to be concerned with. Again, I like to focus on EBITDA and more specifically operating cash flow. Typically, you should see EBITDA and operating cash flow be close together, not much difference there. Warren Buffett and Charlie Munger will probably have a fit because they say, interest and tax is an expense, depreciation and amortization is an expense. So you have to take that into account. But in my opinion, it's not as bad as that. And then this next slide, they've sort of gone through it. This slide here. So they start the year off, the profits and just the expenses and the adjustments are made to why there's such a discrepancy. And you can see depreciation amortization has gone from 10.2 to 22.3. And the other things here is, what else is the big one? The income tax expense benefits gone from negative 4.5 to positive 3. So that's the reason why we've seen a large discrepancy between the two. Looking at the chart, not much happening with the chart, to be honest with you. There's no significant trend at the moment. If you go back from a year ago, the price hasn't moved much. In fact, it's come down a little bit. And that's why, even though the business is actually doing much better, we haven't seen much of an increase in share price. And that's probably why it's probably good value right now. Now, my take on this, in 2014, I was following this drilling company called Titan Energy, TTN. Now, you can't follow this company now because it's gone into administration. So there was a rapid mining downturn where just mining companies weren't drilling at all and they weren't finding any business. So I think Titan Energy, not in drilling company, they also were in housing. And so they were in difficult problems for a long time. They just weren't getting any business. So they went into its administration. And it took a year or two before Titan Energy turned into the company called Allmake, AU8, which is a Daewoo store chain. Am I spelled Daewoo right? No, I can't remember. Daewoo store chain in Australia. They're having troubles now because there's no Daewoo buying at the moment in Australia, or very little. So I'm wary of drilling companies or just mining companies in general or mining services companies because they are highly dependent on the cycle, the mining cycle. And at the moment, though, there's a lot of mining services companies, especially on the lower market cap, that are fairly cheap. So Mitchell Services, Westar Industrials, that new company that's IPO'd, the Blast and Drill Company, DDB, I believe their code is. But anyway, I have two portfolios. So a long-term portfolio. And in the long-term portfolio, I hope to hold a company for 5, 10, 20, 30 years until the story changes. So with Mitchell, if I put Mitchell Services into my long-term portfolio, the story would have to change. And the story in this case would be a mining downturn. The other portfolio is a sentiment portfolio. So when a sentiment shifts from a negative to positive, for instance, Costa Group I've just bought a few weeks ago, that sentiment's change. Usually you see a share price starting to increase. So Mitchell Services doesn't fall into that category. So I've put Mitchell Services, I've taken a smaller position of Mitchell Services, and I put it into my long-term portfolio. So I tend to hold that for a while until the story changes. And hopefully in 5 or 10 years, it becomes a 10-bagger for me. Fingers crossed. Real thumbs up, fingers crossed. So is Mitchell Services a buy or value trap? So at the moment, I will say it's a buy, much less a value trap, unless I'm missing something significant. But at the moment, the business is doing really well. But just keep an eye on the mining cycle. and to see if Mitchell Services stays in drilling. They might lose some business if we go through a mining downturn again. So that's all for today. Hope you enjoyed this video. If you need some professional advice, make sure you seek out a professional, because I am not a professional. So have a good day, and I'll talk to you later. See ya.